Welcome to Nirmal, ladies and gentlemen. I'm Hiral Dadia. We have with us Mr. Sunil Subramaniam, MD and CEO at Sundaram Mutual Fund, joining in. Welcome to the show, Sunil, and a happy Diwali and a happy New Year to you and all the viewers. Sunil, my first question coming to you is, if you have to compare the last 2 to 3 years, in terms of performance of the markets, how would you actually describe this Diwali?
Well, I think that this has probably been a very interesting year because we look at last Diwali, actually October was when the FIS started pulling money out of India. Till June, they were pulling money. If I remember right, about 2.5 lakh crores, $35 billion, they pulled out from India. So from around about Diwali last year, the first subsequent 9 months wasn't great. Right? The markets obviously reflected that because, as you know, 40% to 45% of India's free float market cap is owned by FIIs. So though we talked the money as 2.5 lakh crore, there was actually only a change from 45 to 40. So only about 5 to 10% of the FIs moved out, but even a small move by the FIs makes a big move to our markets. So that first 9 months of the current year, from a Diwali year perspective, was very volatile. Then from July onwards, we saw that the situation in American economy had got out of hand in terms of inflation. And so they decided to have a strong inflation targeting exercise of hiking interest rates, announcing quantitative tightening and all of that. That period of action, actually what happened was made the world fear that a recession was going to come on in America, because the only way you can target inflation in America is by cutting demand, by impacting demand. Housing, for example, is 40% of America's CPI index. So the interest rates started hiking. So normally when you see the tightening cycle, that's the time people fear that money will go out of India. But a contrarian move started then. What happened was that the fear of a recession being brought on by the Fed's actions actually led to commodity and oil prices starting to come down. And hence, India became attractive because global liquidity of $30 trillion is lying there. 600 billion is all that India gets from it. So from a perspective that October last year to June, when the commodity prices were rising, money went out of India into commodity exporting markets like Brazil. But moment it was very clear that Fed is not going to worry about growth and only target inflation, there was this move of commodity prices started coming down, and that was viewed as favorable to India. And India actually got about almost 50,000 crores in July, August, September, that quarter. So the markets, just that small amount made a huge difference, because markets went back to lifetime high, because though only 20% of the money came back, what went out in 9 months, in 3 months, the market went back to lifetime high for three reasons. One is domestic flows had been strong right through. The SIP book growing from last Diwali, if I remember, it was around 10,000-11,000 crores. This Diwali, we are touching 13,000 crores. So you're talking about over that 1 year, almost 1.5 lakh crore of SIP money coming into the market. So Indian market, though it fell, that was cushioned by the domestic support. And when FI money came back, it was FI money plus domestic money, both buying the market. So that small amount of FI money came in itself, make the market to rise up. Right? That's one. Second thing is also the outlook for the Indian economy. When a commodity price rise, there was a fear about corporate margins will shrink, and it actually happened. So Indian markets didn't fall despite corporate margins falling. So valuation then was a question, saying markets are not respecting the fundamentals. But then when commodity prices started easing, right, that benefit was obviously going to be there for India's government through fiscal deficit and trade deficit, to India's companies through the thing, and to India's consumers, because imported inflation will come down. So all in all, with the commodity prices coming down, the earnings story has started to look better, right? And this Diwali, I have a reason to look at it with optimism, because I see that even now those interest rate targeting has not fully worked. So it's going to continue for some more time, at least another year. You're going to have interest rates being high and targeting. So which means that the commodity prices are going to continue to ease. Indian economy is going to benefit. And because of COVID and the pandemic and the first wave and the second wave and the third wave, consumption did not take off in India because of the lockdowns, because of the fear of people gathering. A pent-up demand around consumption, around air travel, around hotels and on services is now beginning to play out. So I think that this Diwali is a beautiful trigger for there will be a good news on the demand front for consumer thing. And because the capacity utilizations have now, crept up above 75% for India, CapEx cycle is also starting to play out. So government CapEx, PLI is coming in and supporting through CapEx, private sector is announcing projects. So I think both the twin engines of growth for India, that's investments and consumption, are poised to fire. So I have a reason to believe that this Diwali is actually a very, very optimistic outlook for the next year coming in from all of these places. So I think from last Diwali to Diwali, we've been through a lot of volatility, but I think times are looking fairly decent. Yes, a recession coming on in America and Europe would affect Indian exports, would affect to some extent. So one has to keep that in mind, that export-oriented sectors like IT, pharma may see that those kind of growth rates may not happen because of a recession. So while there will be some impact on our economy, I think the domestic engines of growth are fairly strong.
So would it be right to say that clearly in terms of growth, we are outperforming? Secondly, if you see in terms of the earnings as well, Q2 earnings, the early ones have been pretty okay. FI selling is declining, and there is a steady rise in DII buying as well. And the pent up demand that we are seeing, during the festive season now, these are factors which are going to actually tell us where the markets are going. And with this, do you think this pre-Diwali rally will take us probably to levels of 18,000?
Well, see, 18,000 will happen. How quickly it will happen is the question. See, the thing is that end of the day, remember that Indian economy to some extent is decoupled from world because it's only the exports get affected. Indian markets, however, are very coupled to the world, right? So while a softening commodity is good news for Indian economy and should be positive for FII flows, news flow around the US economy is a constant input into other markets. And hence they say, no, when the Dow sneezes, India, whatever, right? So the news flow around America still dominates a lot of, what I would say, hot money, which has a tendency to make the delta change. The fundamental core 35 to 40% of our market's ownership by FIs will not get affected, but that delta between 40 to 45, right, keeps affected by news. So volatility will be there. 18,000 will definitely be hit sometime, but the news flow in America, unfortunately, is hard data. No American people are able to not predict what the unemployment data is going to come out, or the housing starts going to come out. It is proving, and the better the good news on America, the more the interest rates are likely to be high, because they want growth to cool down, they don't want growth to grow now. So it's a very good news is actually bad news, and bad news is actually good news.
Yes, go on.
So because of that, I would say that the period of volatility, also the commodity price falls have not been mirrored by oil price fall. Oil hasn't fallen to the extent of other commodities. For India, oil is very important. And the reason it hasn't fallen because of the ganging up of OPEC, where they are controlling the production, not to let the supply of oil be in excess, number one. Number two, this is the winter season in the advanced countries. So core demand for oil will remain. Whatever you do, people can't be without heating their homes. So whatever you do, interest rate hike, all of those, that oil demand is going to be strong for this quarter. So oil price will not drop as much. So that is not, the more oil price looks likely to drop, the better the news for India. So that is a tempering factor, that in the short run, oil may not fall to the extent which was anticipated. And I think that has a very, very close link to hot FII money coming to India. If they predict that oil is going to stay at 90, then that quantum will be less. If they see oil heading to 70, then there'll be a lot more people rushing into play into the Indian stock market.
Right. So would it be right to say, Sunil, that the global situation probably could come ahead and put a cap on the upside to our markets in the short term. However, the downside seems to be protected due to the kind of fundamentals we see for ourselves in the medium to long term.
Not just fundamentals, domestic flow.
Hmm.
See, because domestic fund managers, when they have money, right, they tend to buy good quality stocks when FIs sell. So there's a bottom always coming up because of the support from domestic MFs.
Hmm. Hmm. And overall, so in a current situation, what should be the asset allocation strategy or approach right now?
So I would say that if you look at it, I took it in three ways. So first, in terms of economy, I would say focus on domestic versus exports. So your as you know your focus should be on domestic economy related stocks or sectors. That's number one as a filter. Second filter should be that you should always keep from a sector perspective those which are relatively insulated from international matters like banking and financial services,
Hmm.
right? Like domestic consumption, right? Like capital goods. So these three should dominate the portfolio, no? Between BFSI, investment cycle, and the consumer cycle, I would say you should form 75-80% of your portfolio in those. That's the number two.
Hmm.
And number three would be from a Capco perspective, because of the previous two factors, I would say that you keep yourself at a 50% large cap and 15% mid and small cap with the filter of domestic filter being applied across this all the three, right? That means I'm talking about a multi-cap and a flexi cap being the right position as a fund today, as opposed to choosing any one cap curve. You need to have that multi-cap approach here because the future growth is going to be provided by mid and small caps, but your protection is going to come from large caps.
Hmm. 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 Right. So overall, with this kind of an approach, if you have to see from a sector, perspective, of course, there has been a rotation that we've seen already by now. Clearly, the view is domestic oriented sectors are the ones to be in. However, best is to avoid export oriented sectors, as we mentioned about, say, IT, pharma as well. Now, IT has been an interesting one because clearly, if you see IT, because of COVID, everyone spoke about how the fundamentals have changed and the importance of technology, the digital aspect coming in, and that's what could be the beneficiary for the sector. However, now we are talking about, the export side of it because the global economy has changed and how the recession could hit IT budgets as well as it happened probably back then in 2000 or even back then in 2008. So would it be right to say that a sector like IT could be a safe haven, but not the best investment bet?
I think that's a beautiful way to put it. Because when I say no exports, people shouldn't say zero IT
Hmm.
because remember that there's a core part of IT which will always be needed. The COVID post-pandemic growth that IT was expected to do may not happen. So
Hmm.
valuation which rose up will come down to cooler down levels. But IT has to remain a core part of your portfolio because the need for IT is not going to go away. Number one. Number two, in a recession, IT is a big portion of a cost of a user industry, right?
Hmm.
Whether it's a BFSI industry, the pharma industry, they're in the US or Europe. So it's a big portion of their cost. So cost reduction in IT by switching from A to B, from Infosys to Wipro or Wipro to Cognizant, Cognizant to Mindtree. That rotation will happen. And the ones which have got a good cost economics, fast turnaround, will gain market share at the cost of others. So within the IT sector, there'll be a lot of company rotation in terms of who will be the winner in able to grab a big order away from competition. So picking good IT stocks, which proper study could actually deliver good value to you in this period because their market share can go up. So overall, the sector may not do well. So I agree with you that IT has to remain a part of the portfolio, but don't put it as a major part because the growth story of IT has kind of changed post the pandemic expectations and the recession coming into play.
Right. And apart from that, another space that has really picked up pace right now is the banking side of it. We've seen n number of themes that have emerged over the last couple of decades, especially in the BFSI space. Say, there was a time when we actually saw NBFCs emerge as a big theme. Before that, even private banking was something that really caught steam. So from here on, do you think now overall banking as a pack is something we should be watching out for? Because clearly, if you see the earnings in the last 2 to 3 years, we've never seen the banking space in this kind of a scenario, in this kind of a situation or position that it was earlier.
Absolutely. I think a lot of things have changed for the banking industry. The first is that I think the support provided by RBI
Mm.
during the pandemic, right, in terms of helping restructure loans. So what was a potential NPA? By giving him extra time to repay, you avoided that NPA. Second is the liquidity support given by RBI meant that all the banks had enough cushion to provide for NPAs more than required. So they are all in the bad times. People are really expecting bad news from banks during the pandemic. So they actually did that by dampening their profits and creating provision, extra provision more than required. The third thing that they did was, though RBI was making them very cheap money, they actually used that availability of RBI money as a basis to go and raise long-term money, whether it's from retail customers through 5-10 year fixed deposits or from international through masala bonds. They locked onto low cost funds when the time was right. Right. And the other thing that they did was they quickly switched all of their loan book, barring auto loans and barring personal loans, into a floating rate environment.
Mm.
Right? So what happened is that when the interest rate cycle turned and interest rates started rising, right, what they did was for every paisa that they dropped, in the deposits earlier, they only raised it by 1 or 2 paisa more, but they raised the loan rates on the book, right? So only incremental deposits suffered the higher cost of deposit,
Mm.
but the 70% of the existing loan book earned them a higher return, right? So what happens is all their net interest margins widen. Then they had provisions, which they had excess provisions, which they could write back to improve their profits. So in that context, if you see now with the investment cycle developing, bank credit is already rising 15-16% YOY. But as you know, every investment project has to have a 70-30 ratio. 30% will be capital by the promoters or the public, and 70% has to be bank loan. So corporate loan book is going to see a massive demand from the banking system. And in the corporate loan book, the pricing is much better than in the retail loan book. You get housing loans today at 8.5%, but corporate loans to small and medium corporates are anywhere between 12 to 13%. So you're straight away making 200-300 basis points more profit from corporate loans than from retail loans. So I think that that fundamental dynamic change for the banking industry has made a big difference to their future outlook. And I'm personally very bullish on the banking sector.
Right. And overall, Sunil, apart from that, if you see in terms of other themes, from a manufacturing perspective, from a cap goods perspective, specifically cap goods, because last few years we didn't see really a good amount of, inflow investments coming in from an infrastructure perspective. Now that has started to pick up not only in the government sector, but also in terms of the private sector, and the order books execution is something which is actually picking up steam. What would your view be on these two?
So I think that the next decade is a decade of manufacturing,
Mm.
because there are three drivers for manufacturing happening. First is the government. See, it's basically the fact that China is slowing down in terms of additions to working age population, in terms of their wages having gone up a lot, in terms of their negative political conversation with America today because of the whole war situation. I think that there's a huge move to move business away from China into other countries. And India, because of its labor advantage, stands in a good space. But the lack of a proper infrastructure is preventing us from fully exploiting that. So the government has identified that as a core area. And there are two things the government is doing to make India more attractive as an investment destination for foreigners, which is one is trying to improve our infrastructure.
Mm.
by making it the roads and the waterways and the ports and the airports. So about 100 lakh crore is what the government over a 5-year period is trying to spend to make. Why? Because the ease of doing business. There's a key component is how fast can I get my product from the factory gate to the port or to the airport to export it out of India. So that infrastructure spend is going to create its own demand for investment side, small and small cap companies, whether it's cement, if it's steel, is building materials, whatever. The second thing the government is doing to target and attract this is to give financial incentives to foreigners. How have they done it? First, they cut the tax rates for new manufacturing to just 15%, right? The second is they gave this PLI scheme where they said 5% cash back for 5 years if you come and set up a plant. So that PLI, in our estimate, is about 2.5 lakh crores of capex, which will happen over the next 12 to 18 months. That's the second driver. So government-owned capex, PLI capex. And the third, as we discussed a few minutes ago, is that with capacity utilization going past the 75, 76% level, private sector is starting to now invest for fresh capacity creation. So suppliers of capital goods are going to see their order books rise from these three capex cycles. And I see manufacturing as a percentage of GDP go from 15% to 20% easily, which means that we are going to see roughly a 3 times to 4 times quadrupling of the manufacturing output of the country from its current level of $300-400 billion to probably $1.2 to $1.6 trillion of manufacturing. So I think this decade is the one of manufacturing for India, and anything related to manufacturing. And the government, in addition to what I didn't mention, is the fact that government in the Atmanirbhar Bharat has identified defense as a key area where we want to indigenize our production. So domestic defense production is also going to get a huge boost from the government because India's defense spend is very high. And to the amount that you can save in paying it in dollars instead of pay it in rupees, it'll be a huge boost to the currency. So I think that the manufacturing is in a sweet spot. The thing is that with manufacturing, because these are small and mid-cap companies, there tends to be the cycle of stock market performance there follows a very unique trend. So what happens is that because we are coming off a downtrend, these companies' valuations have gone rock bottom. But the step that we go forward now is that first the order book comes. Based on order book, the valuation goes up. So what will happen is these companies will look expensive for some period of time until the orders are executed and the earnings comes in. And that's when the valuation will correct. So this is the sector we've got to be very careful because everything will seem expensive. But certain companies there are going to actually beat the market's expectations of earnings because of the V-shaped way their recovery. They are highly operating and financially leveraged companies, right? So 10 rupee rise in their income top line will need a 25 to 30% rise in their bottom line. But the opposite was also true. 10% rise of drop in sales will mean a 40% drop in bottom line. So it's extremely V-shaped in terms of the way that works. And some companies may disappoint. So it's got to be a sector where I would say you don't play it individually. Always choose a diversified mutual fund to play that story because it's fraught with this anticipation coming ahead of actual reality.
Right. I think that's an interesting point that you made. And my last question coming to you, Sunil, is a lot of investors who want to play safe right now, taking the volatility into consideration, not really thinking of how India is probably still a safe haven, are seeking safe havens in the debt market as well. And a lot has been spoken about right now in terms of short term bonds due to the tightening liquidity, where there's a possibility that we could see a boost in returns. So, what's your view with regards to the debt market? And within that, specifically with regards to ultra short term debt schemes?
So, I would say that there are two types of debt investors. There's an equity investor who wants to park safely in debt because he's scared about the volatility, right? The second type of debt market investor, the person who, because of the taxation benefits of debt mutual funds versus fixed deposits, wants to invest in a scheme which will get better post-tax returns. But he's a debt investor, right? To the equity investor who's looking at debt as a safe haven, given the volatility in the markets, I would suggest the hybrid schemes within the equity basket, like an equity savings scheme, a balanced advantage fund, where the fund manager decides on how much debt he will take, provides that safety to that, but at the same time has a right to increase equity when he sees that the situation is good. So I would say because he's by heart an equity investor, just a little bit worried about the volatility at this time. So because when you move into pure debt, you're locked in for 3 years from a tax perspective, right? So you can't take out your money, otherwise you will suffer that short-term capital gains tax, right? So for such an equity market investor, I would suggest increase allocation to the safer hybrid products, which give you equity taxation, at the same time the flexibility of the fund manager to increase equity when he feels the time is right. Okay, so that's that type of investor. I would treat him this way. To the pure debt investor who is looking at interest rates are rising, the ultra short term is an excellent fund to invest in. Why I'm saying this is that in a rising interest rate scenario, you are going to anyway stay for 3 years as a debt investor. You want to reprice your assets every short quickly so that you get the benefit of the rising yield curve. Whereas if you choose a locked-in 3-year product today, the problem is that you can choose target maturity funds. If you are very clear that you don't need your money for 3 years or 4 years or 5 years, choose the right target maturity fund, because if you stay for that period, you'll get the interest rate that is prevalent today, you will get it. But if you're uncertain about your time, if you're saying, okay, I know I will stay for 3 years, but I'm permanently a debt investor, I want to keep, then the ultra short-term kind of schemes are a better bet, because you don't get mark-to-market losses on your book, because they are anyway limited to about a year in terms of their, Macaulay duration, right? So the repricing of the asset that takes place as we see India gradually into an interest rate tightening cycle, right? You will get the benefit of that in the yield year upon year upon year. So where you are not very sure about when you need the money, you're anyway there for 3 years from a taxation perspective, but would like to keep your money for say 5 years, 6 years, but are not an equity investor. You want to be in the debt space and you want better than FD returns. Then what you mentioned as ultra short term, right? I think is a good play. There are similar categories which are also called low duration, which you can consider. There's ultra short term, there's low duration, and there are short term funds, which have anywhere between 12 to 36 months. So a mix of these category funds with ultra short term being the main entry vehicle there would be ideal for a debt investor who's looking better than FD returns.
Absolutely, and that's a good advice coming in there as well. And I think a right time to have this kind of a conversation right now as well. It is festive season. People want to probably invest. A lot of thoughts as to where to invest and how to invest. But thank you so much, Sunil, for this great conversation today. Happy Diwali to you and the viewers once again. Stay safe and speak to you soon again.
Yeah, happy Diwali from my side to all of you, to your investors also. Thank you.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from Nirmal Bang.